You've been dabbling in investment properties and it's time to sell one of your investment properties. Maybe one of your colleagues said you should 1031 exchange that property. Well, what is a 1031 exchange and how can it help you? I'm Tiffany Weber. I'm a real estate attorney in the Lake Norman area of North Carolina. I've done thousands of real estate transactions, and today I'm going to tell you about 1031 exchanges and how they can be used in trading investment properties. I have worked with lots and lots of investors who regularly use like-kind exchanges whenever they're selling investment property. Now, a like-kind exchange is what most people call 1031 exchanges. And 1031 is actually the section of the code that allows this type of exchange to occur. Whenever you sell investment property, you generally have to pay tax on the gain from the sale. But whenever you use a like-kind exchange, you can defer paying the tax on the gain so long as you replace the property with a similar property. So like-kind, that's why it's called a like-kind exchange, because you have to be replacing with an investment property that qualifies and meets all of the rules of Section 1031. Now again, this doesn't mean that you won't pay tax on the gain, but it means that you can defer it for now. Here is an example. Let's say you own an investment property and you're going to sell it for $100,000. Let's say you have a really big gain and you don't want to pay the taxes on that gain right now. So you have identified another investment property that's worth at least $100,000. It could be worth more. And whenever you sell your current investment property, you use something called a qualified intermediary to hold the funds that you made from the sale. And then whenever you're buying the new investment property, that qualified intermediary puts the money into the purchase of the replacement property. And that is, in its simplest form, what a 1031 exchange is. It's where you take the money from the sale of investment property and put it directly into a new investment property within a certain time frame. I would encourage anyone with an investment property that they're looking to sell and potentially replace with a new investment property, reach out to a company called a qualified intermediary. So these companies are all over the country. You don't necessarily have to work with one that's in your state, though it may be more convenient for you to work with someone in your state. But this qualified intermediary is a company that essentially serves as the, for lack of a better term, middleman to hold the money. Because what you don't want to happen is for you to receive the money from your sale, because once you do, that's it. You gotta pay your gain, you gotta pay your taxes on the gain. So as long as you're not taking control of the funds and they're being paid to that qualified intermediary, then you'll still be eligible to do the exchange under Section 1031. So I would recommend that you just Google qualified intermediary in my area or qualified intermediary services. And when you reach out to those companies, they're essentially going to give you some paperwork to identify that they're going to be the exchanger, they're going to be serving on your behalf. They're going to identify any fees that they have for their service, because they don't do it for free, of course. And then they're going to kind of walk you through the next steps and tell you how long you have to identify the replacement property. Also, you're going to have to assign any contracts you have for the sale and purchase of your investment properties to the exchange company as the purchaser on your behalf or the seller on your behalf. Another common question I get is, okay, let's say I'm selling an investment property for a lot of money. Say I'm selling it for, $750,000. What if I can't find a replacement property that's $750,000 or more? Well, as of right now, you could identify multiple properties, and you could say identify 3 different houses for $250,000 each, or any combination to reach that amount, so long as they qualify their investment properties, they meet the other qualifications under Section 1031. So it doesn't have to be one property for one property, but it does have to be same or equal value if you're going to try to defer the gain on the sale. If you are going to identify multiple replacement properties, to my knowledge, they don't all have to close in the same transaction. We've, in our office, closed replacement properties in more than one transaction, but they do have to occur within the required time frame that the IRS has set forth in Section 1031. And your qualified intermediary will walk you through all of that. And I'm not sure whether the intermediaries charge separately per transaction. I imagine they probably do. But you can close on the replacement properties in more than one transaction so long as you do it within the required time frame. All right, I'm not a tax lawyer, and that is because I don't want to be, but we're going to bring on a local CPA to talk about 1031 exchanges in more detail. That's because these were just the basics. They can get very complicated. They don't have to be, but a CPA is going to do a much better job explaining the tax implications than I want to. So look for that video coming out soon to talk about 1031 exchanges in a little more detail than we talked about today. Like this video if it was helpful, and comment below if you have any other general questions. Note, I'm not going to answer legal questions in the comments. But also subscribe if you want to know more about real estate law in North Carolina, because we put out videos just like this one all the time so that you can learn more. I'm Tiffany Weber. I'm a real estate lawyer in North Carolina, and I'll see you in the next video.